Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update for the housing market here in the Phoenix area, and we also get into some national news that applies. So let's go ahead and jump right in. I'm going to share my screen with you here, and we're going to talk about uh, the good old Federal Reserve with such interesting information. But it's important that we look at this so we can kind of understand why the market is affected the way it's affected, right? So Fed raise, first of all, as we always say, interest rates are driven by inflation. But the Federal Reserve, whether you like them or not, or agree with what they do or not, they relate to the party, but they've been taming inflation. And instead of, we went over this a little bit last week, but they did a rate hike of 25 basis points instead of the 50 or 75 basis points that they've done in the past. That came out last week. So no surprise there. We'll see the same thing happening over the next 2 or 3 months at least, and then we'll see what goes on from there. But the funny thing is, at the one hand, kind of we see, it seems counterintuitive, but what in the Fed's mind is if they're taming inflation, taming the money that's being uh, used in credit, so to speak, that means the money you spend, the amount of money you go out and get in credit, because when that credit is produced, it's produced out of thin air and it creates more inflation. Now, in reality, the most inflation is created when we print that extra money for a lot of ridiculous programs that are out there in the country. Right, wrong, good, or bad, whether you agree with it or not, the numbers are the numbers and the data points are the data points. And the more money we print, which we print more money in the last 18 months than in all human history. But when you do those things, that's what creates the giant inflation that we're seeing right now, along with energy policies, some of the energy policies that we're seeing with the ESGs and some of the things that are coming in to really stifle energy dominance. Okay. So that's the reality. Those are the data points. I know a lot of people don't want to hear that. I know a lot of people don't like, to hear that the housing market may even be on a rebound, believe it or not, but I'm going to get into that in a minute. And then again, the numbers are the numbers, the data points are the data points. So I want to talk about these job report numbers. At first, everybody was like, wow, this is great. If you look on the screen here, it says, job reports show increase of 517,000 in January, crushing estimates as unemployment rate hit 53-year low. And then it goes into all of the details of that. You would think it goes into all details anyway, but it doesn't. But let's getting into all the things here that they're showing. It looks like everything's great now for the Fed. Believe it or not, they're like, oh, so there's a lot going on here because they're just like, oh, well, if people are hiring, that we're not really taming inflation enough, because if people are getting jobs, then they're going to go out and spend money. Okay, that's just how they think about these things when they're trying to tame inflation, which it makes sense from the way they're trying to do things. I don't agree with a lot of the things that they do, but that's a whole nother story. But anyway, because of the way the economy works right now, the treasury markets were like, uh-oh, the Fed's not going to be happy about this. So we've seen, with all these adjustments, basically we went down a little bit, we went up a hair, and now we're right back where we were again, as far as rates are concerned. And that's why it's important to understand how these things work and what's happening with these things. The Fed doesn't necessarily set the interest rate, but they do or can have an indirect effect on the interest rate due to the way they're either taming inflation or allowing inflation to grow. They usually like to see about a 2% inflation rate. And obviously we burst that bubble a long time ago. But we've seen that we hit the peak already of inflation right around probably October, November, just like we talked about. And now we're seeing that inflation get tamed, even though stuff is, costs a lot, even though we're seeing in certain sectors, tech sectors and different areas where people are getting laid off. We're also seeing reports like this. But when you dig into the numbers a little bit, Zero Hedge went into the details of some of this. And, well, when you get into it, I'll kind of summarize it for you, but Zero Hedge talks about this in their article. And it's what was behind today's wow jobs report. That was on February 3rd. So you can reference that, look that up. But let me turn that ringer off. Okay. Oh, sorry about that. So basically, they go into the fact that, well, yeah, whoopsie, they even say that whoopsie here in the article. A lot of this is, number one, seasonal part-time, and part-time from the sense that people needed to get second jobs, or maybe they even need to get a third job, or they have 2 or 3 part-time jobs because the middle class full-time wage or job isn't there. One reason for that is we sent them all over to China, and we're trying to get that back now. Look at the Taiwanese plant here in the Phoenix area, right? So we're trying to bring that tech and that sort of tech and that sort of manufacturing back, along with, they're talking about, pharmaceuticals and all kinds of different things, bringing that stuff back. So we'll see what happens with all that. But Taiwanese plant here is a big thing, with the advanced chip design. We really need that, but that's probably a couple of years before that really starts to produce, and really probably another 2 to 5 years after that before we really start to see, huge production for that. So hopefully we can weather the storm with the, China and Taiwan thing. They're saying that's a couple of years out. Hopefully they're right. And again, I just mentioned these things because they're all kind of interconnected and related, and deal with this. But on this jobs report, we see that in reality, the total, it says right here, the total U.S. full-time workers declined by 10,000 over a period of 10 months. Meanwhile, part-time workers soared, okay, from 25.9 and some change million to 27.4 million, an increase of 1.492 million. Okay. So it goes on to say, so at least we know where the bulk of the increase in the U.S. labor came from over the past year. Virtually no full-time jobs, okay, and all part-time. Okay, then it goes on to say, it talks about the economists here in Bloomberg, chief economist Anna Wong put it, the January jobs report showed extremely robust growth, higher than usual estimate. Excuse me, allergies. Apologize. In the Bloomberg survey, if it seemed to be too good to be true, that's because it is too good to be true. The gain is mostly due to the seasonal factor and revisions to the past. The Fed likely won't place too much weight on this report in formulating policy, unfortunately, because in reality, what they're doing, whether you agree with it or not, as far as taming inflation, trying to, when you raise these Fed's fund rates and you do this taming of inflation, you stunt job growth, you stunt the guy who wants to go out and buy the factory to produce the jobs and the product. you stifle manufacturing and product development. So from what's being said here, and what was interesting about this article too, is it goes on to this is how Goldman Sachs showed the seasonal hurdle, that is the fudge factor going into the January print. So they're kind of giving a little slight to Goldman Sachs there. And honestly, with Goldman Sachs report on the 4 cities that were supposed to be in decline this year in the housing market, I don't know who's doing their information flow, but they need to really up their game there. So I think they really need to work on whoever's doing their data. I'm not agreeing with it. So anyway, again, for rates, again, this all affects mortgage rates and where we're at, and what the Treasury bond market's doing, all that good stuff, right? So we see, a wild ride for rates after stunning jobs report. Because again, the Fed doesn't like that. Treasury markets like, what do we do? We're confused what's going on here. You're saying this, but then we're getting this data after the fact when we really dig into the numbers. But in reality, it's just kind of stabilized. Okay. So, we're right in that mids, depending on the day and the week, right in that mid to low. We're going to be right in that mid to low 6 range without doing any 3-2-1, 2-1 buy downs, buying down rates with decent credit for a 30-year fixed rate, conventional. And then for government loans, you're probably going to see, it more into the 5s, which is good. But remember those 3-2, 3-2-1, 2-1 buy downs. I always mention them, but you can actually start your first and second year, 2 to 3% interest rate, and then your seller paying the concessions right now with the way the market is. And if you go to refinance later, which you can without any out-of-pocket costs, once the rates go down, remember, we're looking for May. We're going to see that year-over-year numbers of inflation just continue to drop. And we're going to see April, May, especially in May 10th, numbers come out from the Fed, huge drop off. Okay. So keep that in mind. Just like we talked about the Barry Habib numbers. He's always right again. What's likely. And he was right again on inflation peaking when it did this last time. So next article, because we were over 7% in interest rate, guys. So, that really slowed things down in the housing market. Now that we've seen rates drop pretty much almost, a whole percentage point. Okay. It's really, heated things up along with the seasonal busy season. Anyway, spring, summer is always busy in most markets. Phoenix area, school that's out in May, it's going to get busy every year. It's the same thing. So so now the mainstream media and these articles, these people who write these articles are starting to catch up. Like we talked about the last couple of weeks, they're starting to get out of the December numbers and into the January numbers. And it says probably past the worst. Housing shows signs of stability, stabilizing to round out 2022. No duh. We knew this. Okay. All the people out there, with, the tons of followers who are, because the crash sells, when people hear housing crash, all these people on YouTube talking about the housing crash incessantly. Why? So they get followers and they come and take parts of the data and use little bits and pieces of the data, and they don't really show you the whole story. Like we talked about before, foreclosures are up. Yeah, they're up, but they're like almost at all-time lows, but they're up because there were no foreclosures due to forbearance last year during the pandemic. Okay. In the last year and a half. So everything's relative, guys. You got to really dig into the numbers, got to really look at the data points and see what's actually in there. Okay. So the housing market has, it says here, the housing market has borne the brunt of the Federal Reserve's aggressive interest rates, but mortgage rates are now on a downsizing with 30-year fixed slipping to low 6s. And then it goes on to talk about, as Redfin Glenn Clemens said last month, the housing market in January was stronger than anyone could have hoped. We're gonna dig into that, especially for the Phoenix area. We're gonna talk a little bit more about that. Still, as they said, still signs are a little tepid. To purchase a home, mortgage applications to purchase a home fell 10% for the week ending January 27th, which marked 41% drop from a year ago during the same period. Now in our market, we're going to get into the numbers where we're actually seeing things like going insane. Okay. It's kind of crazy out there. So not anomaly, crazy insanity market like we had, but it's heating up really quick. And just as 16% of the prospective buyers said now is a good time to buy, the same as November, according to the survey. Okay. So builder sentiment, the biggest obstacle for home builders in 2022 was the pessimistic outlook carrying into new year, but there are signs that viewpoint has changed. Confidence among single family builders in January rose for the first time over a year, ending 12-month stretch of declines and signaling a potential turning point in the housing market. Okay. The turning point for the housing market is happening, guys. Probably it says probably the worst is behind us. And then housing starts. American builders continue to slow down home construction in December as housing starts fell 1.4% last month. The annual rate of 1.3 million homes down 22%. Commerce housing start for single family homes rose 11.3% to an annualized rate of 909,000, while multifamily housing starts came in at a rate of 463. Okay. Permits slipped. And then it goes on to say existing home sales in December fell to an annualized. See, because these are the old numbers. These are the ones that they're looking at. And in December, it doesn't surprise me. Is during the holidays, with a 7% or high 6% interest rate, okay, so an 11th consecutive month decline in December, but still better than the rate of 3.9 million expected by economists, according to Bloomberg data. Okay. The median sales price for an existing home jumped 2.3% to 366 compared to a year ago. Okay. So even with everything and all the doom and gloom, prices are still up, guys, nationally. Okay. And they still are in the Phoenix area too. So let's jump ahead. Pending home sales. National Association of Realtors index of contract signing to purchase previous owned homes rose 2.5% from the prior month in December. Okay. So you see, we're got out of the holidays. They're starting to ramp up and rates have dropped. December to end 76.9, ending a 6-month slide, according to a release on January 27th. What did I say the last couple of weeks? When we start seeing those January numbers come out, as we were watching them in real time, okay, all these publications are always lagging. They're not looking at what's trending. Okay. So signed contracts of previous owned homes fell in the Northeast, Midwest, and we're so we see that in the South and West, which posted monthly gains, all 4 regions experienced a dip in transaction for the year, with the West taking the biggest hit. This recent low point in housing is likely over. Mortgage rates are the dominant factor. Again, everybody's in hibernation. Why do I need to sell my home till rates drop? Because where am I going to go? The inventory is still very low. And why am I going to go from a 3 or 4% interest rate to a 6 or 7% interest rate from where we've been the last few months? It's a no-brainer, guys. But the demand is there. It's just hibernating. When these rates drop, okay, and we get into the seasonal thing anyway, it's going to happen. New home sales, okay. So it basically saying it's going to stabilize the market when the rates drop a little bit more. New home sales rose 2.3 last month, an annual pace 616, up November, according to the report of census. Okay, so medium sales price on a new home stood. The average sales reached the end of the month. Current, meanwhile, in recent reports, home builders suggest they're responding by slowly heading back into the market amid lower mortgage rates and better pricing. Now, I'm going to get more into this for our local area. We're actually seeing where one builder reported that they're actually up year over year, even from the crazy time that we were in before. So I usually like to get into our CMI. That's the Cromford Market Index. The people over at Cromford are amazing. They are our local gurus who basically get us all of our real estate data, and they're right on the mark. They really keep up with what's trending, and they've kind of been doing this for decades, so they know what data points to look for, and the dynamics of everything, and the critical path to get us where we're heading. So the Cromford Market Index right now tells us, and again, I don't care, just some people out there that are just recession outside of the 2008 recession, which caused okay, was caused by the housing market. That recession was caused by the housing market due to over inventory and poor lending practices because of over inventory. They had too much inventory. They relaxed the type of loans that they were doing, programs, brought out crazy programs, and we crashed. Okay. That's one of the biggest, at the heart of it, that's one of the biggest reasons why we had what we had. But that recession was caused by the housing market. But in recessions in general, okay, I've done other videos on this. I'll probably do another one just to remind everybody of this. I'll keep it short, and maybe I'll throw it in one of my shorts on YouTube. But it's really a big difference, because we see that when there's a recession, rates drop, and that means people buy homes as long as they haven't lost their job, and that's certainly a factor. But and this economy, you know, we're seeing that people also have a ton of equity, which they didn't have back in 2008, and we don't have the poor lending practices that we had back then, and we don't have the super high inventory that we had back then. You know, back then we had 3.81 million. Today, you know, overall, we're right around 1.2, 1.3 million. And a good portion of that is even under contract. In the Phoenix area back during the crash, again, I always spit out these numbers, but it's important to note we had 56,000 homes, okay? And we had all these builders overbuilding, but 56,000 homes for sale when the crash hit. Today, I looked on the MLS, we have 15,000, all property types active, 15,000, okay? When these mortgage rates drop, people will be like, okay, now I can move, okay? And that's usually the time of year people are going to want to move anyway when they really drop off around April, May, all right? Mark my words, we already saw this at the end of the year when the inflation peaked and the rates dropped way down from 7 or over 7. They were over 7. So, all right, CMI, we are in a seller's market, guys. We are technically in a seller's market. The Crawford Market Index from 90 to 110 on the index chart, from 90 to 110 is the balance range, 100 being completely in balance. We are at for all the Phoenix metro area, we are at 117.9. We have ticked up. That's a huge increase from where we were. We were below 100 at one point. Last week, you know, we were only, what were you, like 112? So it's ticking up pretty quick. And we are technically in a seller's market, and really outside of a couple cities, they're all trending towards seller market. Now, it's not crazy insanity market, because this index was way up in the 3s and 4s during the insanity market, but we are over 110. So we are at 117.9, almost 118. We are in a seller's market, guys, in the greater Phoenix area. So does that mean you're not going to get concessions? Does that mean you're not going to get some good deals on some properties right now due to the fact that the interest rates are so high? No, of course you are. And we can certainly help you get those concessions, get those 3-2-1 buy downs, 2-1 buy downs, have the seller pay for those concessions, your title fees, all that stuff, and to get you into those lower rates. Okay. But the fact still remains, we're technically in a seller's market. We're starting to see things move pretty swiftly. We're starting to see more foot traffic on the back end of our Showtime system. We can go in there and actually look and see what's going on. We're seeing a lot more people coming through open houses. We're seeing a lot more offers, we're even seeing multiple offers on properties now again. So just the usual, you know, cycle. We get it, you know, after the holidays, you get into tax season, start moving into the end of winter, spring, things are just busier. Okay. No matter what the interest rates are, they're just going to be busier. Okay. So now demand, we're at 77.5. So, you know, again, we are definitely below that balance range there. You know, if we're below 90, we're in a buyer's market overall. And if we're above 110, we're in a seller's market. So overall, we're in that seller's market, but demand is at 77.5. And that's definitely been increasing as we go. And then supply, it's still very low. I mean, we at one point though, we were at 20. Like I remember when we were at like 20 on supply. Right now we're at 65.7. So it's definitely gone up. from the insanity market that we were in, way back before April, May of last year, and the year previous, moving into that time period. But right now, 65.7 on the supply, which, again, is much lower than balance. And these two numbers, if demand and supply numbers were the same, which they're not, we would be in a balanced market. So supply is at 65, demand at 77. Okay. Now, as far as the individual cities, we have seen, now this is interesting, guys. This is where it really gets into some interesting data. All of our cities are trending up except Fountain Hills and Paradise Valley, but they're still in the top 3 as far as the high end of the Crawford Market Index in sellers market, or the highest end of all the cities. Because Fountain Hills, even though it's trended down 6% on the index, it's still at the top at 161.5. And Paradise Valley is -3 on the index. It went down 3%, but it's still 149.7, again, over 110 sellers market. So those are always up in the top 3 or 4, or top 2 usually. But Chandler is now up 35% at 157.7 on the index. Okay, so that's definitely the sellers market. Phoenix makes up 25% of our entire central market. Okay, so Phoenix proper. Okay, and Phoenix, as far as our total sales, and Phoenix is also up. Okay, the Phoenix area is also up 25%, the city of Phoenix. So huge gains there. It is in a seller's market at 132.2. Cave Creek is at 130, Avondale 130, Glendale 130, Scottsdale 125, Tempe 125, Mesa 125, and Gilbert at 115. Now Peoria is the only one really at balance. Peoria is at a balanced market. Okay, but it's also up 21% from where it was previous week. And we see Surprise is 95. So it's low end of balance. And then the rest of these are all in a buyer's market right now, but they're all trending up. Goodyear is at 81, but it's trending up 20% in the last week on the index. Meaning this just means there's more demand. There's more demand, right? So it means better for sellers, basically, right? There's more demand, better, or there's less inventory for the demand. Okay. Again, supply and demand, right? So Goodyear is at 81, up 20%. Cream Creek 70 at 27%. Maricopa 60, it's at 60 and it's up 10%. Maricopa City, and then Buckeye is at 57. Again, these are all buyer markets, these last few here, and it is also up 10%. So that's the story there. But amazing, Phoenix making up 25% of our market, and it's up 25%. Again, not an indicator that we're heading for a crash, guys. Okay, it's going up 25%. That makes up 25% of our market, our central market. Phoenix, of course, Phoenix metropolitan area, but Phoenix proper makes up about 25% of our total market sales. And we are seeing this 25% increase on the Crawford Market Index. So not seeing a crash, guys. I'm just not seeing it. Okay. Month over month, we've seen a change in the entire index on average of 18%. Before that, we were at 20% increase, and before that, 22% increase. So we're seeing it kind of, slow down a hair, but it's still steadily creeping up. Okay. So that's actually good though, because then we were not going towards insanity all at once, right? When those rates drop though, look out. I think we're going to see a stampede happen. Okay. A stampede happen. I think that we're definitely trending in a good direction in a healthy market. Meritage Homes, just as an aside, I got a note here. Meritage Homes in January reported 4% higher home starts, homes, that people were going under contract with or starting their build, 4% higher than January of 2022. Wow, right? So that means there, more sales, more properties going under contract now than were a year ago. Well, part of that is, people are catching up with the affordability. They're giving some really amazing prices on new home builds right now. You can get some really good deals because the end of the year, the interest rates just slowed everything down. And then we ran into the slow time of year. So how long those deals are going to last, I tell people, let's get ahead of the curve. Let's, we can get you those 3-2-1 buy down, get the low rate 2-3%, but get the low cost on the home now. Get it now. Okay. Get ahead of the curve. Always the people who end up the best get the best, deals, get the best investments, get the best, turnkey things that are happening in, products and services are always ahead of the curve. So guys, before, I'm telling you, April, May 10th, that's going to be the big one. Be ahead of that. You buy your home now, get the 3-2-2-1 buy down. You got the money sitting there in escrow from those concessions, bought on your rate 2-3%. So you're back to levels of where we were a year and a half ago on rates, but you got the super good price on your property. And when you refinance, there's no out-of-pocket cost, and you can carry over the money sitting in that escrow account that the seller paid for and refinance your home to a fixed rate. Because the 3-2-1, the first year or two or three, depending on which one you're going with, it's going to go up each year by about right around a point or whatever. Again, the loan officer can kind of go through it in detail. But if you're starting this year at 2 or 3, it's kind of a no-brainer, especially if we know inflation is falling, which automatically means rates are falling. Okay. Just automatic. And again, I'm not saying people aren't hurting out there. I'm not saying eggs don't cost too much. It's stupid how much eggs are. It's ridiculous how much things have gone up, and it was totally avoidable. Totally avoidable. I blame, government, the Fed, the Federal Reserve, they handled it incorrectly. Okay. But that's par for the course, right? Okay. So the homes that we're seeing again, the kind of the biggest gains for the cities that we're seeing the biggest gains. We're seeing as far as the biggest gains week over week, Carefree, Gilbert, Mesa, Glendale, Goodyear, Phoenix, Peoria, and Sun Lakes. They had some of the largest gains week over week, month over month. Okay. So the other thing that we saw in January was we saw an increase of properties going under contract between December and January. Okay. What was going on in December to January? We saw an increase from 5,456 properties going under contract, 56, up to 7,810 homes going under contract. That is a huge increase, and 7,810 is a good number. Okay. We definitely want to see those kind of numbers. We want to see numbers, where we're, we're hitting well over 6,000 homes going under contract like that. That's a good brisk market to be in. Okay. So overall, we're seeing that increase percentage wise was a 43% increase from December to January, 43% increase in homes going under contract. And you may say, yeah, it's seasonal, Chris, like you said, yeah, from December, now we're out of the holiday. Yes, but also it's the fastest growth from December to January, month over month, that we've ever seen in our market here in the greater Phoenix area, according to the Cromford report and our MLS, our multiple listing service. So where all homes are listed and sold basically for sale. So guys, that does not scream crash in our market anyway. Okay. And nationally, overall, uh, things are looking good. Things are going to get better, but it's the highest, that's the highest increase month over month. Those are some good data points, some good signs. Whether you agree with me or not, the facts are the facts, the numbers are the numbers, and the data points are the data points. All I can do is share that with you. Again, what is likely to happen is all we can share with you from the data points, from the history of what we know. Okay. You get into a recession, it's usually not bad for the housing market, because recession also means lower interest rates, which means more affordability in housing. Okay. Yes, some people are losing their jobs, and that's horrible. A lot of people overhired for certain tech sectors and certain jobs during the pandemic. Those jobs maybe are no longer needed, and it's sad that people have to lose their jobs, but at the same time, we have to look at the reality of what's going on with what's happened in the history of what's going on and what's happening now. People get stuck on that 2008 thing, and it's certainly something to keep in mind, but we just don't see the foreclosures. We don't have the inventory that we had back then. We just don't have the poor lending practices, guys. We just don't have all these factors that would create that, and we're seeing a surge in numbers of people going under contract and application for loans and all these sorts of things. So guys, if you have any questions at all, want to get a home evaluation, free home evaluation on your property, want to learn more about our pricing strategy, our price bracketing strategy, which is sure to get your home sold top dollar, over asking, over market value every time, because we're going to capture the most amount of home pre-approved, very well approved home buyers. We're going to make sure that you're getting the most value for your money there. And guys, if you're looking for a home purchase, we can certainly help you with that. Our realtors here are going to make sure you're looking at the best properties available for whatever your goals are. And we have some great lenders that we work with, mortgage brokers, so you're going to get not the retail fees that you would normally get with some of the retail lenders out there. You're going to get better rates than the average rates that you see out there in all these reports and stuff. You're going to have more options in type of loans, even for home builders. They're coming out with some amazing products where it takes a lot of the risk away from home builders. With actually a new product I saw today. We're going to do a video on that. Hopefully in about a week, we'll get our mortgage broker on here and kind of go through that with you. So guys, if you have any other questions at all, reach out to me. I'd love to be able to talk to you more about the process and how things work. And it's 480-788-8569 is our team line. You can call or text Cynthia and our team here. You can check us out at McCulloughhomes.com, McCulloughgroup.com, and on all social media. See you next time.